Okay, Canada got a decent inflation report this week. Core inflation is basically back at the Bank of Canada's target. Mortgage interest costs are finally starting to tick down. So obviously bond yields went up, right? What? Bond yields went up? I know, I know. Welcome to 2026, where good news seems to come with a catch. Becky Perro here, independent mortgage broker, trying to make it make sense for you and your mortgage decisions. Let's start with the good news. Canada's inflation came in at 2.8%. That is well below what economists were expecting. And the number the Bank of Canada actually obsesses over, which they call average core inflation, dropped to just over 2%. It's exactly where they want it. If we strip out gas prices, inflation is running at 2%. And if we strip out food, energy, and taxes, it's running at a cool 1.5%. Rents are growing at the slowest pace in 4 years. Mortgage interest costs just posted their first year over year decline since mid 2022. This is all really good news. No sarcasm here. But here's the catch. Gas prices are up almost 29% year over year. And it's not because of anything happening here in Canada. It's because of what's going on in the Middle East, where the ongoing conflict is creating real uncertainty around oil. And the bond market, which is basically a giant room full of nervous people with spreadsheets, looked at that situation and said, we don't love this. Canada's 5-year bond yield hit a 22-month high. That matters to you because bond yields are what drive fixed mortgage rates. Bank of Canada Governor Tiff Macklem said it plainly earlier this month. If oil prices stay high and it starts pushing up the price of everything else, they may need to raise rates multiple times. Now, nobody is expecting a rate hike at the June 10th meeting, but later this year and into 2027, the market is pricing in rate hikes. And when the Bank of Canada starts hiking, historically, they don't stop at one. Here's how I want you to think about this, because the right answer isn't the same for everyone. The first question to ask isn't fixed or variable. The first question is, what is the intention of the property over the next 2 to 3 years? Here's something most people don't realize until they're sitting across from a lawyer paying a penalty they didn't see coming. Breaking a fixed mortgage and breaking a variable mortgage are not the same thing. It's not even close. If you break a variable mortgage early, your penalty is 3 months of interest. Annoying? Yes. Survivable? Also, yes. If you break a fixed rate mortgage early, your penalty is calculated using something called the interest rate differential, or IRD. And depending on your lender and where rates are at the time, that number can be eye-watering. We're talking thousands, sometimes tens of thousands of dollars. So if there's any chance you might sell in the next few years, a variable rate isn't just about hoping rates go down, it's about keeping your exit cheap and your options open. On the other hand, if you're staying put, you know your income is stable, and the idea of your payment changing keeps you up at night, fixed might be worth every penny of that rate premium right now, especially with the Bank of Canada potentially moving towards hikes later this year. Strategy is the foundation of the conversation and ultimate decision. The bottom line this week, inflation's behaving, the global situation is not. Fixed rates are competitive, but that window may be closing.